In the fast-moving world of investing, one principle continues to stand strong no matter how the markets change: diversification. Whether you're an experienced investor or someone just starting your financial journey, spreading your money across different asset types, sectors, and markets is one of the smartest ways to manage risk. Diversification doesn't eliminate risk, and it's not meant to. Instead, it helps you balance that risk more effectively, reducing the impact that any single investment can have on your overall portfolio. When one asset dips, another may rise, creating a smoother, more stable investment experience over time. By understanding how diversification works and why it matters, you can build a portfolio that not only protects your wealth during market downturns but also supports long-term growth. It's a foundational strategy for investors who want consistency, resilience, and financial success in the years ahead. Understanding stocks, bonds, and mutual funds. When you're building an investment portfolio, it's important to understand the core financial instruments available to you. Stocks represent ownership in a company and offer strong long-term growth potential through capital appreciation and dividends. Bonds provide more stability by paying regular interest over time, making them ideal for balancing risk. Mutual funds pool money from many investors to buy a diversified mix of assets, which makes them a simple and accessible option for beginners. Each of these investment choices comes with its own level of risk and reward. Knowing how they work helps you make smart decisions and build a plan that supports long-term financial growth. Risk tolerance. What it means and why it matters. Before choosing any investment strategy, you need to understand your risk tolerance, which is the level of uncertainty you're comfortable with when investing your money. Your risk tolerance depends on your goals, age, time horizon, and comfort with market fluctuations. Younger investors with more time to grow their wealth often prefer higher risk investments like stocks, while those nearing retirement usually lean toward lower risk options like bonds or index funds. Understanding your risk tolerance helps you choose investments that align with both your financial objectives and your emotional comfort level. Diversification. The key to safer investments. Diversification is one of the most effective ways to protect your investments from unexpected losses. Instead of putting all your money into one asset, you spread it across different categories such as stocks, bonds, real estate, and mutual funds. This reduces the impact of any single investment performing poorly. A diversified portfolio gives you more stability, minimizes risk, and supports long-term growth. No matter your investing experience, diversification remains a core strategy for building financial security. How to start investing with a small budget. You don't need a large amount of money to start investing. Anyone can begin with small, consistent contributions. Technology has made it easy for beginners to invest through micro-investing apps, low-cost index funds, ETFs, and platforms that allow fractional shares. Setting up automatic contributions helps your money grow regularly, even when market conditions change. The most important part of starting with a small budget is consistency. Small contributions add up over time, especially when combined with compound interest. Begin by building an emergency fund and reducing high-interest debt, then gradually direct more savings into your investments. What matters most is developing the discipline to stay committed for the long term. Conclusion. Building a strong financial future through smart investing. Investing may seem overwhelming at first, but once you understand the basics, how stocks, bonds, and mutual funds work, what your risk tolerance is, how diversification protects you, and how to invest with a small budget, you can take control of your financial future. Start where you are, stay consistent, and focus on steady growth rather than quick wins. Even small investments can grow significantly over time with patience and informed decision-making. The best time to start investing is now, and every step you take brings you closer to long-term financial stability and wealth. If this video helped you understand accounting a little better, don't forget to like, share, subscribe, and turn on notifications for more accounting tips and guides.